The last 12 months seems to be a consolidation period for Indian equities. It was an election year in India which slowed down activity and capital expenditure from the government reduced. GDP growth dropped to a low in September 2024 and the earnings growth from corporates for the year was in low single digits. Valuations were already high and coupled with lower growth led to profit booking in the market. Further, the tariff announcements from the US worsened sentiments. Foreign institutional investors sold in the Indian market, further putting pressure on the market and the currency. However, now we think that most of the negative factors have turned for the better. For the current financial year, GDP growth has been forecasted at above 6.5%, with the first quarter seeing a growth of 7.8%. Capital expenditure of the central government has already seen a significant increase in the first half of this year. Inflation has come down, interest rate has been cut, and corporate earnings is improving. From a low single-digit earnings growth last year, the market is expecting a growth of about 8% in this year, improving further to 16% in the next year from the Nifty companies. With the time correction witnessed in the last 12 months and the expectation of higher earnings growth, valuation has come in line with the long-term average. Overall, we believe that the market should recover in the next 12 months and resume its positive journey. US accounts for about $87 billion or about 20% of India's overall goods and exports and is only 2.2% of GDP, which is much lower compared to the same for other Asian peers. Within exports, a significant portion is exempt, including electronics goods and pharmaceutical ingredients. This effectively reduces the actual impact on exports to an estimated 0.8% of GDP. Currently, as per media, negotiations are on between the two countries and a lower tariff is expected by the market. Also, because many of the key sectors impacted are in the unlisted space, like gems and jewelry, seafood, leather goods, etc., the overall impact on the investment universe is very limited. A part of the negative sentiment towards India from foreign portfolio investors was contributed by the tariffs as seen in the FPI outflow in equities between July and September 2025. If there is a reduction in these tariffs, the sentiment could change to positive. Rationalization of GST rates is also a very important and significant reform from the government. Simplification of the tax structure eases compliance and gives a large stimulus to the consumption within the economy of an estimated 0.6% of GDP. The revision has corrected the inverted duty structure on many products. In addition to this, income tax rates were cut by the government and the central bank has reduced interest rates by about 100 basis points. All of this is likely to boost domestic consumption. The government has budgeted about $130 billion for capital expenditure in the current year, which is a 7% increase over the previous year. Having already achieved a 3.2% capex to GDP ratio, it is likely that the budgeted spends henceforth will increase in line with the nominal GDP growth. However, there is a significant focus on a few sectors within infrastructure like power generation, renewables, power transmission, defense, electronics manufacturing, etc. Power demand in the country is growing at about 5.5 to 6% per annum, and to meet this demand, power capacity is likely to almost double over the next 5 years. Also, the government has committed to increase the renewable power capacity from about 225 gigawatts to about 500 gigawatts by 2030. This would also require revamping the transmission grid. Defense is another area of growth where exports are expected to increase from about $2.8 billion now to about $10 billion by 2030. The electronics manufacturing industry is estimated to see production increasing from about $100 billion currently to about $500 billion by 2030. In addition to these, the Indian Railways is expected to spend a significant amount of money on high-speed rail corridors, freight corridors, and logistics parks. The Indian Semiconductor Mission is gearing up to build a full ecosystem in India, with the government offering significant fiscal support to projects. Similarly, green hydrogen projects, river linking, data centers, etc. are also likely to attract significant capex in the next few years. Hence, we remain very positive on the infrastructure sector in India. Thank you for your continuous support for our India equity funds. India continues to be one of the few areas in the world that exhibit high economic growth. At HSBC, we are committed to helping our clients to make the best of the opportunities arising from this growth story. We are one of the asset managers that provide the widest range of products that invest in different sectors, and we hope to bring you more products in the future. Hope you found this video useful. Thank you for watching.